in Microsoft Dynamics AX 2012. My name is Anders Even Girke, and I'm a program manager in the SCM team in Vedbæk in Copenhagen. And I'm here to present the features that we have done in AX 2012, AX 2012 feature pack, and lately in AX 2012 R2. So I have stuff from each of the versions that are new that I would like to present. And first slide here is the traditional special gift for technical conference. We jump that, we go to the disclaimer, and that's because I'm also showing some 2012 R2 stuff. I think you have all read that already a couple of times. So I will jump into my session focus, and I'm really going through the full costing cycle. We start with costing sheet and cost estimation. Then we go to moving average, which is a new inventory valuation principle that we introduced in 2012 feature pack. And as that was originally most a release targeting retail customers, I would think that most of you will probably see it as a new implementation in 2012 R2. So more customers will probably upgrade and will ask what is moving average in 2012 R2. Then I will talk briefly about inventory close, where we have done some significant changes in the R2, which we will also backport to 2012. Then we go to reporting and reconciliation, which has been a cumbersome task in AX if we go prior 2012. I will go through the capabilities we have in 2012 and also an extension that we are doing in R2 that help us reconcile. And lastly, I will go through Insight by Microsoft Excel and a new inventory value cube that we will deliver with R2. And this is one of my only slides for this session. So I will jump directly into AX and demonstrate how the costing sheet has been evolved in AX 2012. So I go into inventory management and costing sheet. And I will expand it. And I'm really sorry about the resolution, but that is in order that people in the behind can actually see what I'm showing up here. So I have to move forward and backward a bit. So in AX 2009, we shipped the costing sheet for the first time, and we allow people to configure a cost structure for cost of goods manufactured, also known as conversion cost. What we did in AX 2012 was that we extended the capabilities so we can also define a cost structure for cost of purchase. Because a material cost in inventory is not only the cost of the material, but is also the overhead that runs on top of the material cost. That is your inventory cost of that purchased material. So in 2012, we have our header here, which is the cost of goods manufactured. And if I collapse that one, we can actually see that we now have the possibility to define a cost of purchase as well. And it works the same way. I define some cost groups that my materials that I purchase run into these cost groups, and then I can define a set of indirect costs that runs on top of these materials. And in my case, I have made a very simple costing sheet. So I have all my raw materials relating to one cost group, and then I can calculate transportation indirect cost on top of that. And we also introduced some new capabilities in the way that you can define your indirect cost in 2012. Probably they are most secret for most of the users, actually. But in 2009, we had surcharge, which is that you can actually add a percentage on top of the cost. And we had rate, which added a rate on top of the cost. A fixed rate, so you could see $1 on top of one quantity is added. So, but in 2012, we actually made it possible that you can do them quantity-based. So we have input unit-based and output unit-based. And input unit-based means that whenever you consume a product during the production, you can add indirect cost on top of the consumption. And you can do that based on the input, based on volume, and on weight of the consumption, of the product you consume. On the output, we can actually also do that when you report as finished. So you produce a finished good, but by finishing the production, some overhead runs onto the finished good. And you can do that by adding indirect cost based on output basis. And here you can do it based on quantity, weight, and volume. And in AX, that is posted during the product production order, report as finished. Then actually indirect is added on top of the cost of the finished good. And if you want to configure your purchase indirect cost, you have only two accounts to be set up, because the offset account of this is, of course, the inventory. So these two accounts here is only for the absorption of your expenses. In this case, it's transportation. So I have a transportation cost that is already expensed in my profit or loss. But the costing sheet, when I make my purchase order of the item, absorb that expense account in my profit or loss and transfer it into become a balance in the inventory together with the item. And if you're doing standard cost, we have full traceability of this. So we actually know if you're doing standard cost, the roll-up preserves this information that you consume a raw material that actually has indirect cost. Where if you are actual costing in AX, all of this automatically becomes material cost. So how is this used in the cost calculation? So if I close down the costing sheet, because it does also make a significant change in the way cost is calculated in AX. In the prior version, we always called it the BOM calculation. That terminology is completely off now. Now it's just cost calculation, because it's not only related to BOM, meaning produced items anymore. Now the cost calculation engine runs first of all purchased items to figure out is there any cost that needs to be calculated to the inventory cost, and then it starts running on the produced items. So a significant change in how AX works. So, and this also ties back to how you define a product in AX, because now when you create a product in AX, we don't have the type of a BOM item type and an item type. But we still have a default order setting, because it's important for the cost calculation to know how do you source this item? Is it actually purchased or is it produced? Because that has significant impact on how the cost calculation engine will calculate the cost of the product. So that's why we have the default order settings. But what if the product is sourced through purchase order on one side and is manufacturing on another side? Then we actually have the item coverage, where you can go in and set a specific sourcing type for that specific site where you're sourcing to. So that means you can actually have that and the cost calculation will then calculate a purchase cost for site number 1, but it goes through a BOM calculation on site number 2. Yes?
Can you do both on the same site? Meaning, in case you are have to make the decision between make or buy?
No. Good question. We cannot currently not cope with that you do both on the same site. It's not because you cannot do a production on site 1, even though the cost calculation calculated a purchase cost. If you're standard cost, that just means you get a lot of variances, because you've chosen from a standard cost perspective to purchase the item. And that means your roll-up is based on a material cost from purchase and potentially some indirect cost from purchase, but you actually produce the item. You can do that, which you also could in 2009. It's just default settings, but you will get some variances in your cost calculation, because now you actually produce the item and you use different cost groups and so on, so you get variances, but it's still possible. You can change your mind on the product. Yes, you can change your mind on the product. True, you can also run 2 calculations in simulation mode and see which one do you want. But from running, you need to have 1. So now in the costing version here, sorry, the wrong one. And I have a very simple BOM defined, and I have 2 raw materials for that BOM. So what I go in and do is that I will define some purchase prices for that on my site number 1. So the first item I purchase at 10 per unit. And on my second raw material, I will purchase it also for site 1 at 20 per piece. And this is very, very important. In 2009, you would just add your cost on your purchase materials here, and that was it. And then you run the calculation. But now, because I've defined a structure for my product of purchase, it's very important that I actually enter purchase cost here, or purchase price. And it can also be taken from a trade agreement if you define that in your costing version. So what I will do now is that I will close this form and I will go to my calculation tab because I want to calculate my BOM item, what is going to be the BOM cost, and what is actually the cost of my raw materials. And I will do that for site number 1. And we can also see here that we actually say that this costing version should calculate both purchase order and productions. This is also new in 2012, that you have the purchase order option down here. And we go to select. And I will just write in my criteria because I don't want to run a complete BOM calculation here. So this is my criteria for my 2 raw materials and the finished good that I want to calculate. And I press OK. And it's already done. So what I can see here is that I had my purchase price that I entered in as $10 US. But my inventory cost will be 11.5. And that's because indirect cost is added on top of it. And I can actually go in and see that in my version here to see, yes, the material cost is 10, but you added 1.5 as indirect cost. So that means also when I go now and create a purchase order, the system will actually add 1.5 in indirect cost on top of the purchase cost and add that to my inventory account. So that's actually how the costing sheet has been evolving in 2012. So the next topic I want to move into is moving average, which is a new inventory evaluation principle that we have shipped. And for most of you, it will probably be new in the R2 version. So moving average is a perpetual costing method. And that means every single transaction you post is recorded at a specific time because we actually add a timestamp into the InvenTrans table. So we know exactly the second you create each transaction. And that's how we can sequence every single transaction in an order. And at the time you do the transaction, we do the cost calculation. So every purchase order executes a new cost calculation. And that also really means that you don't have to run. That means the inventory close doesn't really change the cost when you're doing moving average. You still have to run your inventory close because there are some things happening through the inventory close so that you close the period. But when you create an issue transaction, at the time you create the sales order packing slip, the cost is assigned to the issue. And it is not changed ever in the system. And how do you configure moving average? It happens in the same way as you configure the traditional inventory evaluation principles. So you go to item model group, and we can create a new model group. I will create my moving average here. It has to apply to stock products only. And down here we have the tab inventory model. And we can see that in the drop-down, I have a new option called moving average. When you click this on, there are some prerequisites set in the system already for you. That means physical and financial inventory is always posted to ledger. So that means we can at any given time reconcile your inventory, physical inventory, with your financial inventory. So how does moving average work? So let's go and make a purchase order, Sorry, I just forgot. I need to set up 2 accounts, of course. Moving average works in the way that it actually calculates proportionally when you make your purchases. So let's say in the scenario is that I purchase 2 pieces and I estimate the cost of my purchase is $10 per piece. So I put them into my inventory at an estimated cost at 10 per piece. I then make a sales order, and I sell one at 10, because that's the moving average. But when I get the invoice of my purchase order for the 2 pieces, the cost has gone up to 12. So right now the system, because it cannot change the cost of goods sold on my sales order, it would put one at 14 into inventory. That is wrong. So the system, what it actually does at the invoice time is that it proportionally calculates how much has been sold that I'm currently receiving into inventory. And therefore it will expense 2 to a price difference account, which is really a correction of the cost of goods sold, but we are not correcting it because you already sold the pieces to this customer. So we are not fluctuating the inventory by putting 14 into inventory because you only purchased the pieces at 12. So you need to set up an account for that. And then, again, because moving average is a perpetual costing, if you need to adjust moving average, which you can do at any given point of time, you can go in and put in, I want a new cost as average cost. You can do that at any given point of time, and we reevaluate your inventory, which is a little bit similar to standard cost. But again, you should never really change your standard cost as often as you change moving average cost. But you can do that at any given point of time, and that is why we need a revaluation account as well, because that means you expense your revaluation to that specific profit loss account. And these 2 accounts can be found in Invent Posting. So we go to Setup and Posting and click Posting. And on the inventory, we can see that 2 new accounts, or 2 new posting types, has been added, and you need to configure these 2 accounts. And then you're really set to do moving average in AX. So first I will do a purchase order on one of my raw materials. I select my item here. Oh, too fast. I put in my warehouse and my site. I want to purchase 2 pieces, and I put in the cost of 10 per piece just to demonstrate that actually the proportional calculation is happening in real time. And I want to confirm my purchase order. And then I will do my product receipt. And I press OK. And I receive my goods into inventory. And if we look in inventory, we can see again that I purchased the 2 pieces at 10 per piece, but because I have my costing sheet set up to do indirect cost, we are actually absorbing from our absorption account here of transportation cost, we are absorbing that into my inventory account here. So my inventory is actually written to be 22.5 and not the 20 that I purchased it. So now if I go to my item, which is also very important when you're doing moving average, and look at the on-hand by going via View Details, Manage Inventory, we have this on-hand form here. I can always trust that the price shown here, when the item is evaluated by moving average, this field here, cost price, will always show you the current moving average of this item. Always. So I will go do a sales order for my item here. So we go to Accounts Receivable, Sales Orders, press New. select a customer. And I need to find my product. It's down here. I sell the piece of 1. And I need to enter my warehouse inside. And we sell it for 100. Have a good margin. Save. We go to packing slip, and we create a packing slip on this sales order. And we packing slip update the sales order. And I will look at the voucher of my sales order. And we can see that the item was pulled out at the cost of 11.25, which is my moving average. Specifically for journals, when you're doing moving average, it's also important to know that if you create a journal and you create negative journals in AX, when you do moving average, you will see that AX fetch a cost for the journal at the time the journal line is created. And you are perhaps slow, or you want this journal to be approved because before you're posting it. Don't worry, at the posting time of the journal, we are recalculating each of the lines that are actually issues and put the moving average at the time that they're posted, not the time the line was created. So it's not always that you can trust the issue cost on a journal line when you're doing moving average. It's only an estimated at the time the line is created, but as soon as you post, it is actually running through the system once again to recalculate that cost. Because we have had customers already running moving average, like say, oh, will it post at that cost? And I get confused. We need to show you a cost at the time you create the line, because this is the cost at that time. But if you wait 4 hours, the cost might have changed because you have had receipts in between. So if we go back to our purchase order, and we want to do an invoice update, I just have to do it in the right place on this box, because otherwise I will get a warning and an error message, sorry. Yeah. 2 pieces. Yes, I think this is the right one. So we go to invoice. Generate invoice. Yes, I get a warning, no problem. So what has happened is that now my invoice is saying the price is not 10, it raises to 12. And I will generate my invoice. And I will post it. Yeah, sorry, I forgot that one. No, do it once again. Good catch. Thanks for that. And we walk out. The price is there still, and we will post it. And we have the invoice posted, and we can go and look at the voucher. And I don't have to go through all the individual transactions. We are relieving the physical posting, and we are posting the invoice. But what is important here is that I have 2 posted at my price difference accounts, and that's because the system will not put that into the inventory, because that means my item would raise to a too high amount. It would simply go up too high. Because I've already sold one of my products, but I only estimated the cost at the time of the sales order, because now when I have the final cost, it was higher than what I estimated. And that's why the system makes the correction itself based on that, or based on the invoice cost. It will actually do the same. If you have, there's 2 ways miscellaneous charges can affect this. If the miscellaneous charge is added at the invoice time, it is proportionally expensed or put into inventory, the same as you do with the invoice price difference compared to the packing slip. If you make the miscellaneous charge alone to the invoice, meaning you make a miscellaneous charge posting 2 days after the invoice is posted, that amount is fully expensed. Because then we have no relation to the actual receipt anymore, and we cannot do the proportional calculation. So we need, if you put miscellaneous charges at the time when you do the invoice, that the transportation cost or other insurance cost or other cost is added, we will proportionally expense it because we have the references in place. But if you make the miscellaneous charge 2 months after or 1 month after to that purchase order, it is fully expensed because we cannot figure out how much should go to inventory and how much should be expensed at that point of time. Very good question. Well, I definitely encourage to use miscellaneous charges, but you should actually try to know them when you do the invoice. If you come too late, we expense everything. You can still use miscellaneous charges as part of a direct expense to that purchase order. Indirect is more generic for overhead costs that you planned, so to speak, for the period to be going to each of your items in inventory. So it's 2 very different things. It's indirect and direct expenses that you put on top of your inventory cost. So, sorry.
Miscellaneous charge at the time you're paying the invoice, because that's when you'll know what the rate's going to be. If you're paying a carrier, then you want it to be prorated against your items by weight. Does it disperse then, or it's too late because you've already invoiced?
Can we take? I would like to have your question. Can we take them afterwards so we don't stop? We can take that. It's just so we don't get derailed too much. So this was to prove the proportional calculation and that it occurs in real time of every single transaction. So we also had the customers want to be able to go negative. It's also a requirement that customers can go negative, specifically in the retail and distribution chain, that potentially the store hasn't recorded the items yet in the back-end system, but the store has them physically standing there and the customer wants to buy it and they have it in their POS system, so of course they want to sell the product. So that's why we allow to go negative. And when we go negative at the current moving average that is standing in the system. And we also made it pretty neat when we actually recover from a state of being physical negative. So I want to demonstrate that as well. So we go and make a purchase order. Sorry. First, I would like to demonstrate another part. I want to demonstrate how we do on-hand adjustments. So if I go to my products, my release products first. So what we did with moving average is that you at any given point of time can reevaluate your moving average, because either the prices fluctuate or you potentially made a mistake and you need to correct it. As moving average is pure perpetual, meaning there is no retrospective calculation, which would be an inventory close job that goes back to the point of time where you want to correct the system, and then actually change every single receipt and issue up to today's date, which some customers, especially in retail, says, we don't care. Yes, we made a mistake, we fixed the problem now, and we move on. We don't want to go and correct 1 million transactions for the last month just because we made a mistake. It doesn't make any sense anyway. And we don't care because the customers, we cannot go and we have millions of customers. We don't do any records based on each customer anyway. We look at the big picture. So to make that change doesn't really affect. We just change now and correct the balances of cost of goods sold, and we adjust the inventory, and then we move on. So that's why we also made it possible that you can do on-hand adjustments at any given point of time when you're moving average. So if we go to my product here, and we go into manage inventory and on-hand inventory, we can see that I have one item in inventory, and the cost is currently 51.25. I can actually go to inventory management. I can go two places to do an on-hand adjustment of this product. I can go to the closing and adjustment form, and I can click a new type that is called revaluation for moving average. Or I can execute the same form by going down here in the form here, and then it opens up specifically for revaluation for moving average. And how does this work? Well, it works similar to how you do an on-hand adjustment. The big difference is that if you do an on-hand adjustment in X, it only works for the financial part of your inventory. When you're doing moving average, we have no separation between physical and financial inventory. Everything is inventory. And that means you can adjust, you're adjusting your full inventory when you do this adjustment. So I select site as the dimension, which because my cost object in this case is really product plus site. That is my cost object I work with, and I want to adjust at that level. And I have to go in and pick my item in this case, so I don't list all my items. So the system will very fast show up. This is your current on hand. It's very easy that I have posted quantity equal 1. And in this case, posted quantity is my full inventory, physical and financial inventory. I have a posted value, posted unit cost, very simplistic in this case as I only have one piece, which gives me a unit cost here of 51.25. And I can just go and change the cost and say the cost should now be 51. And then the system actually adjusts itself. And then I can post the transaction. And again, compared, because we are perpetual costing, this adjustment takes effect at the time I post. And that means that's why we cannot change the adjustment date, which you can do if you're doing weighted average and FIFO in AX. Everything happens at the time the system records the transaction. And I press OK, and the system has actually updated. Needy thing is that I can actually go in and see all my adjustments in the past, and I can actually go for the voucher to see the specific adjustment that we did here. So every adjustment gets its own voucher, and that means I can actually have full trace per product how I adjusted it over time. So back to the negative. So now we make that we want to sell two pieces. So we create a sales order for this product. Let me see, find the right one. There. Select my item, and I will sell two pieces. Sorry. Select my site and warehouse, and again, unit price. In this case, I will add 200. Save. And I will do a packing slip. And I press OK. And we can go and check the packing slip. And we can see that I've issued my two pieces at the value of 102, which is the 51 multiplied by the 2. And that's because when we go negative, the system will use the last known moving average to go negative with. If this were traditional AX, it will actually go to the item master and see what cost is there and go negative with that. That does not happen with moving average. It always goes to the last sales order. So even in a case where I go, now I actually went positive and I went negative. What happened if I were at 0 and went negative? It would still see if it can find a sales order in the past, the last sales order done, and take that cost before it goes to the item master and take that as the default issue cost. Because the item master is potentially never even corrected after once you set up your system for the first time. So it's better to go to the last known sales order, if it exists, and use that issue cost. So we are actually negative right now. So now I will make a purchase order that makes us actually positive because we have the goods in our inventory. We were just too late in actually making the product receipts. Sorry. So I'll go back to accounts payable and we'll make a purchase order. The most recent. So based on our transaction timestamp, the last sales order we can find in that list is the cost that we will use. Not entered, posted.
For the warehouse you're on, or
For the cost object you're on. The cost object will be the product plus the financial inventory dimension level that product is on. So let's say that we purchase 2 pieces, or 3 pieces for that matter, and my purchase unit cost is 60 per piece. And I go and confirm my PO, and I go to product receipt, and I will post my product receipt, put in a product receipt number, and post. I will go to my product receipt voucher. And what we can see here is that it actually posted 10.25, and that's because the difference was 9. The difference was 9 in the cost, in material cost, because I put in 60 as material cost. My inventory cost was 51. But it also adds saying, oh, we are also adding 1.5 in indirect cost. And I'm also expensing that because I wanted to put that into inventory, but now I'm expensing that again. So that's why we get up to 10.25 as the expenditure. Because the system knew you actually made a sales order at an estimated cost that were way lower than you actually purchased the material on. And that's why I will correct that. So if we go into my inventory on this product now, we will see that it is the 60 plus my indirect cost added, and not more. And that's why it is 61.25, my average cost. So the system actually can correct itself even when users actually go negative in inventory. I think this is pretty neat because I've seen other systems where this cannot be done. Your user has to go in manually and correct the system because otherwise the calculation can explode actually in the systems. But we have actually been possible to make this that the system can correct itself. So lastly, what about backdates? Because it's also very common that we see customers have to backdate transactions. How does that work in a moving average case? Officially, when you're purposeful costing, backdates is the devil. But we have chosen to allow it under circumstances. So that means, yes, we have a current moving average. We allow you to backdate the cost back in time. But that PO, for instance, will be posted to inventory at the cost that the inventory has right now. So let's say the moving average is the 61.25, and you make a PO of only 50. That means we will actually post this into inventory at 61.25 at that backdated time, and we will actually then make it as a revaluation because your actually purchase order cost is less. Because we will not have that you backdate a cost that suddenly affects the moving average, because that will completely screw up your traceability possibilities. And explaining auditors how did the moving average actually calculate. And how do we do secure that? Because there is a big difference in how moving average is calculated and how your postings are. So we have actually made it possible through a report to justify how the moving average calculation has been performed. So I've made 2 reports to demonstrate that, and I'm using the inventory value report that was shipped in AX 2012 to demonstrate this, because we added a feature in feature pack 1 that allow you to report based on transaction date, time, or posting date. So if we look first based on the actual posting date, and I'm sorry for you back in the room that it probably is difficult to read. I will try to put it up as far as possible. So we don't care about the resource. I'm looking at a single product in this case. And here we can see that I have a beginning balance as of the beginning of October of 1 piece at 30. Then I make another purchase of 2 pieces at 40, which bring me an average cost of 23.33. And we can see the timestamps out here and the posting date. And then I make an issue of 1 piece at 20. How can that happen? That doesn't make sense. The moving average should have been 23.33 at this issue here. So are we doing this right? Out of this, you cannot see it because this is your inventory value. This is not your moving average. This is your inventory value based on posting date. So this is the financial values you have in your system. But if you want to demonstrate how your moving average calculation is taking on, you need to execute the report in a different format, which is we need to use the transaction date, because I need to know in which order the transaction was actually recorded in the system. And here we can suddenly see something that explains the difference, which is, again, we're looking at the same product here and the same 4 transactions. There are no beginning balance anymore because now I'm using transaction time as the main filter. And we can see here that I purchased my 2 pieces at 40 as the first transaction in the system. And then I made my issue of 1 piece at 20. And that's why it was calculated at the cost of 20. And then I did another received at 40. And then finally down here, we can see that the transaction timestamps is that it is posted on the 22nd of October at 10:25, but has a posting date back in time in September. So it has a financial inventory value impact in September, but from a moving average calculation perspective, it is posted as the last transaction in October. And that's also why we can see that the moving average cost is following the right pattern. So we have the evidence of how AX actually calculates your moving average because we have now added transaction timestamp on every single inventory and settlement, so we know in which order every of these transactions occur. And therefore, you can always print a report if somebody asks you, but how did the moving average cost actually evolve over time? You can print a report per product and say this is how it has actually progressed. And again, there's a big difference between the moving average calculation and the actual posting of your financial values. They cannot be the same as soon as you start backdating in your system. So I will jump from moving average into inventory close because that is the next part of the cycle. Now we have done cost estimation through the costing sheet and the costing version. We have done actual costing by moving average. And now we go into the inventory close, which is part of my end cycle that I need to close the inventory. For moving average, nothing is occurring as such during inventory close unless you're doing production. And we will support production by moving average, even though that is not recommended as such, but we are supporting production by moving average. It is good for raw materials. It's very good for raw materials. And then you can do standard cost on your finished good. If you have only one-level BOMs, very simple kitting BOMs and so on, I will also say it's very good to use moving average. And the reason for why I'm saying it's not a good idea for multi-BOM level calculation is that the moving average cost is not retrospective and the issues are not recalculated. That means your cost to the finished good is slowed down in the cycle through the BOM levels. So that's why normally moving average as a perpetual costing method is not specifically designed for production companies. But for raw materials in production companies, it's perfect. For one-level bombs, meaning kitting bombs and so on, it's perfect as well. But as soon as you get into a multi-bomb level, it starts to have flaws in the way that it actually progressed the cost or rippled the cost through all the bomb levels, because the inventory close is not adjusting the issues. So that the idea is to say, saying, this cost on this raw material changed from 10 to 12. That means this semi-finished item should have gone up from 10 to 12. That means this semi-finished item should have gone up from 10 to 12 in each of the levels. That is happening if you're doing weighted average in AX, because we have rippled the cost change through all of your bomb levels. Perpetual costing is not doing that. That's one of the benefits. For production companies, that would be one of the downsides of perpetual costing. So, but what have we done with inventory close? And that's now what I'm telling you now is in general for inventory close, is that we have added some new logic in 2012 R2, and we will also be backporting it to 2012 RTM version. And it can be found under the inventory parameters. You can see my time is slipping a little bit. We can see down here that we have a new field for the one who executes this in the companies that is called number of items per bundle. And by default, the system will put this in at 40. And the idea with that is that we actually completely redefined the way that inventory close is utilizing the batch framework in R2. So traditionally, we were creating one task per product in the batch framework. And we had customers with up to 1.3 million products. And the batch framework had some capabilities problems as soon as you get above 60 to 100 to 60,000 tasks. So it actually slowed down. And and the customer, because they have 1.3 million products, they have also pretty less transactions, or few transactions on the products itself, on 90% of them, and then they have few items that has significant transactions volume potentially. And it took longer to create the task for the closing to even close the products. And so what we have done is that we have actually introduced this group, this bundle, where we are grouping products into a bundle. And each bundle can then be taken and creating a task, become a task, so to speak, in the closing. So you put up saying, in this case, I have 8 extra batch helpers, which means I have 8 traits available in my batch framework. I can have, let's say, 100 bundles of 40 with 40 products in each, and each of these 8 traits will, as they can, take one of these bundles and calculate them. So you will not have more tasks generated at each level that the calculation has to run than you have actually helpers designed. It's set up in the system. So that will create a lot less task in the batch framework, and that also means that we actually run much faster for customers that have a really high volume of products when they do inventory close. For traditional customers that have up to about the 50,000 products, we have seen that it's flattening out. It's the same performance. But it's much more easy for us to investigate what is happening during an inventory close, because the task has become more explanatory for us to understand what happens during the closing. So again, a change that has happened in R2 and will be backported to RTM version. Then I will run into some reporting capabilities that we added in 2012 RTM, and we have also extended it with one report in R2. So customers want to do reporting of the inventory value, and they also have to reconcile end of the cycle to the inventory, to the general ledger balances. And that was a really pretty heavy task to do in AX in the previous versions. So we have simplified that process significantly, first in 2012 RTM, with the inventory value report. How many in the audience here have tried to run that report? A few hands. I'm glad to see that at least. So the report is that you need to design your reports, because it's not only one report. You can define reports for the purpose of your reporting. And as you can see, I've already designed one here for my inventory and WIP versus general ledger reconciliation. And I designed another report that allows me to do the comparison between actual posting based on posting date and transaction time for my moving average investigations. But the idea is that you need to define your reports, and customers can define as many reports as they like. That means they have different layouts for different purposes. You don't have to delete them. you can actually store them, and you can always go back and report based on this configuration. And I must admit, I had some issues with my SSS yesterday, so I had to do all my report on another machine and only show outcomes on this machine here. So let's take the best example first, which is, of course, where everything actually balances. I'll try to put it up as much as possible. So the idea is here I have chosen to report based on resource group. And now we're reporting the full inventory. That means we're both taking in inventory and the WIP inventory. And that's also why we can see that I have material, I have labor, and I have indirect cost, because my WIP consists of all these three components. And we can actually see that I have, in inventory, I have a quantity of, in this case, 196, and a value of 6,446. And because I have configured my system, so I have one ledger account per each product group I have, or item group in AX, I can actually reconcile on the group level. So that's why I can say, let me take the 6,446 and see if I can match that, because I know that my resource group number 1 equals my on-hand raw materials inventory. And I can actually reconcile that. And I can see that my finished good inventory in this case is 0, and nothing is shown in the report. So that's how simple I can reconcile at a lower level as well. I don't want to go to products, because that means I have to create a ledger account for each product. I don't care about that level current. And I can actually do the same for WIP, which is new, really new in AX. This was new in 2012. But I've created specific ledger accounts for my WIP. I have WIP materials, WIP labor, WIP overhead. Then somebody created WIP report as finished. And then we have subcontractor. And I can create the same accounts because I have WIP material, I have WIP of labor, and I have WIP of overhead. And I can go and balance each of these components in my general ledger. And I can see that it actually balanced. And the system is telling me that there is no discrepancy at all. I'm fine. I'm done with my reconciliation. Everything matched. I don't have to go at any lower level than this because I can prove that it matched. But let's take this example where it doesn't match, because this is where it becomes difficult. So let's take up a report where it doesn't match. Because this is where customers really get into how do I then find the problems. So here we have the example saying my inventory doesn't match. I have 6,380 in inventory, but my general ledger only says that I have 6,336. So I have a difference of 44. The system tells me what I'm looking for. And if I go to my WIP, I can also see that I have a discrepancy in WIP of 139.70. And now the big question is, how do I figure out what has caused this? Because there can be gazillion of reasons in the system why I have this discrepancy. Of course, I believe the system is calculating cost correctly and post correctly. That's the assumption. The system is always working. It must be either I configured something wrong in my system. It is complex to configure all of these posting types that exist in AX to figure out where to post. It can also be that somebody actually corrected something in the system, but didn't really know how to correct system, because at least finance people often choose to correct the financial accounts. They have no clue that if you actually want to temper with the balances in inventory and WIP, you have to go to the subledger first to do the adjustment, because the subledger will adjust the subledger and the general ledger. If you only adjust the general ledger, trust me, you will never be able to reconcile again, because the subledger has never anticipated that you would have corrected. So most of the errors actually happens within the system. Within the users of the system. So what would I do to find these problems? In 2012, we actually gave a report out to users in the system saying, you can go and find the conflicts of the inventory. And in R2, we have actually extended that, so we also created the same report, but focusing on WIP. So what can I do? I can actually go and print these two reports. And I will first show in AX where they're located. So in AX, they're located under status, under inventory value. And the first conflict report is the potential conflict inventory in general ledger that we shipped in 2012 RTM. And the second report is the potential conflict work in progress and general ledger that we shipped in R2. So if we go and print the first report, which is the general ledger and inventory, we can actually see here that the inventory value report works based on the balances for the period, and the conflict report works based on a from and to date, where it assessed all the transactions in the from and to date period to see what has been posted to inventory in this period, and then we go through all the transactions and evaluate how has it been posted in the system. Has anybody posted on these accounts with posting types that we do not recognize as inventory, and so on. A lot of validation takes place on every single transaction, and then it actually should be able to find all of your discrepancies. So in this case, based on the values we also got from the inventory value report, we can see that the inventory says that we have 6,380. The general ledger says 6,336. The difference we're looking for is 44. And the system has actually found a transaction with the value of 44 that has been posted incorrectly. And the system is so nice that it even tells us what the problem is, because we are reading a description of the error that we have encountered. And in this case, it is that the posting type inventory receipt has been posted to a main account that does not represent inventory, but the system believes this is inventory. The subledger will post this as input to inventory, but you have actually configured the system as not an input to inventory. And that's why your subledger and general ledger will not balance. And you can even press the link here and then actually jump into AX and correct it. And the same report has now been made for WIP in R2, where we actually do the same balance check, where we're looking at the general ledger balance of 558.70 and work in progress from the subledger, which is saying 698.40, meaning a difference of 139.70. And here the system is a little bit more complex because it actually has to go through all of the inventory settlement transactions that went into WIP, all of the work center transactions that went into WIP, and all the indirect cost transactions that went into WIP, and all the general ledger postings for the period. But it actually will go through all of them and figure out which conflicts that we have set up. And also write a comment. And my comment here is that I have set up a posting type production offset picking list has been posted to a non-WIP account. So the problem is I have set up that a posting that should actually consume materials into WIP has been set to a non-WIP account in my general ledger. And the same can be done for indirect cost, and we are saying the same error messages. This posting type has not been configured to comply with the system and how the subledger and the general ledger works. And in total, the conflicts should add up to my discrepancies, and it does. So the system has found the errors. If I correct these 3 errors, then my WIP will actually balance. So now I've done reporting and reconciliation, but I need to play with my numbers. I have so many information in inventory. I need to do better with that. It's not only reporting the imbalance, reconciling, and that's it. I need to do more with my numbers. I've shown before in convergence and so on that how you can actually take the values from the inventory value report, export it to Excel, and play with it over there. But customers are saying, why? Please make it easier for me. Please make it easier. So what we have done in R2 is that we have actually introduced a cube, an inventory value cube. And it contains a couple of measurements, which is listed here. We have beginning amount, beginning quantity. We have ending amount, ending quantity. We have the net issue amount and net issue quantity, and a lot of measurements here. And then we also have a set of KPIs where we pre-calculate the days of inventory quantity, the weeks of inventory quantity, months of inventory quantity. So we actually do these calculations for you. And we also have them based on amount, because depending on if you're a controller, you will care about the amount. But if you're an inventory manager, you actually care about these numbers based on the quantity. Because there's a big difference in amount and quantity of how you would react on the numbers. And also we are doing inventory turn based on quantity and amount. And how can these numbers be used in Excel? Because unfortunately, we are not really offering any user experience in a role center from a cost accounting yet. But as a user, you can take these measurements into Excel and make your own overviews. So this is purely made based on the measurements that is in the inventory value cube, and it takes not more than 20 minutes to do it. So for instance, from a CFO perspective, I can compare year over year, my beginning quantity inventory, my beginning amount, how much has been received in inventory in the period in all, how much has been issued, and what is the ending quantity. I can check the inventory turn over years, and I can also see the weeks of inventory per amount if that has gone up and down year over year. And it's also important to say, our numbers here of inventory turn potentially doesn't match up to the one you get from the general ledger. And that's because traditionally the inventory turn is a calculation that is done based on financial values, meaning you take your cost of goods sold from the financial statement, and you take your average inventory based on the beginning inventory and ending inventory from a general ledger. It works from a financial standpoint. But if you want to do the right numbers, if you're manufacturing companies, you also need to encounter that I'm actually having on-hand inventory because I'm producing. I have issues because I'm producing inventory. So I'm going down to the product level to do the inventory turn. And that means I cannot use financial values that has no relation to products. And they have specifically not any relation that I'm actually also issuing the products internally for consumption, which is very important as part of my inventory turn to see how important an item is. Then we have the item group in percent of current year, and we have some graphs, which is really an aging report from AX, right? You're showing how the inventory per either, in this case, it's item group level, it can be item. You can slash as much as you like. So this is even an aging report. You don't have to print the aging report in AX anymore because you can just make it from the cube. It's very simple to make it. And then you have the aging report. And we also introduced some KPIs. So we introduced the ABC calculation, which is also a report that are currently in AX. Pretty cumbersome, but here we are actually having our items. In my cube here, this is my products. This is the ending amount of all the products. This is the cumulative amount, so this is how I add up inventory in a sequence manner. And we can see up that I cumulative up to 100% in inventory. And then I'm actually ranking my items, in this case from 1 to 5. And based on how much percentage of value of my inventory the items are, I will assign an ABC classification. Which is okay, it's good to know which items are A, B, and C. But that KPI alone doesn't tell me much, because traditionally 80% of your products will be C items, and up to 20% of your items or 15% of your items will be A items. But that 15% of A items can still be a significant amount. I want to know which items are important to take action on, to investigate. C items I don't care about. B items don't care about. A items is where my inventory value is. So what is important other than checking that I have 100 of A items? Well, it is really to take another KPI, like the inventory turn, and say, but how many times do these items actually flip around during the period? Because they have a significant value of inventory amount, but they also have to turn. And the ones that doesn't turn, well, they just have value standing there. They're not moving anywhere. So take all my A items, and then actually filter based on the inventory turn that is low, below some value. These are the A items I want to investigate. I don't care about the other A items, they're fine. So I can faster make, based on 2 KPIs, I can faster figure out which items are important to actually call this supplier and say, well, can I actually return them and buy some of the other products that I potentially are using in production because for some reason we stop using this product and we have a significant inventory remaining. So you can start taking action and actually free up some of your capital. The ABC or the inventory turn alone doesn't really give you the full information. You need another KPI to match it against to find the most important things. And another thing, the values here are kept in the system because this is a cube. So we can actually compare the KPI of ABC over time. It's also potentially funny to see life cycles to say, okay, these products, they will probably go from an A item to a C item within 3 years. So that also gives you some historical memory. So we know now that when we launch products in this product segment, they start as A items, they're very important to us, but as soon as they're 3 years old, they completely drop, and they're not important for us anymore. So you can get some of these statistics out because these KPIs actually works year over year. You can even compare companies against companies because the cube takes all the data out from the tables, and you can actually even compare measurements company per company. That is where the BI stack that Melinda has shown really put us into the place and say, now we have some numbers here, make it work with the BI stack that Microsoft is also delivering, and AX is delivering through the role centers. You can add these KPIs into a role center if you want. The measurements are now there for you to use. So I just have a few slides to end. So for moving average, if you want to convert, this is the slide that actually gives us the conversion possibilities. So you can go from FIFO, periodic weighted average, LIFO, directly to moving average. It's just to change the flip on the product, and you have changed. The current value you have in your inventory will be your current moving average. Nothing more has to happen. If you want to go from standard cost to moving average, we are allowing that based on a restricted conversion. Sorry. And the reason for that is that standard cost, especially in AIC, as it works in two parallel costing systems, it works based on the invent trans, invent settlement costing system, and invent cost trans and invent cost trans variance. And you need to back out the inventory to 0, then convert to moving average, and then put your items back into inventory. And that is to clean up the second costing system. If you want to convert away from moving average, you can only go to standard cost. You cannot go from moving average to periodic weighted average or FIFO or LIFO. And the reason is really that we have stopped making any relation between the transactions that these methods are using. They're using settlements to relate the transactions against each other. And as moving average doesn't create any relations because everything is happening in real time as perpetual costing, you cannot convert back to one of the systems where we create settlements. 2 minutes, we take questions, 2 minutes. Because that will require the closings to do the settlements between transactions for all the time you've been doing moving average, and that will probably take 2 years before you're done with that conversion then. And simply therefore we don't allow it. So I also have some important articles and white papers here. So utilization of batch framework, white paper will be issued soon. Actually it should be issued while we're here at Convergence. On Microsoft Product Download. We have it automatically in the R2 version, and this is the KB article number you will have to look for if you want it for 2012 RTM. Then we also have optimized the ledger posting task. We have seen that most customers using AX today, traditional 80% we guess, have that 30% of the time of an inventory close is actually used on posting the general ledger task. And we have actually made some optimization to that task that will make it significantly faster. It's implemented in R2 as standard, and for 2012 RTM, we will issue it under the KB article number 27.71.516. Sorry. We also encountered a problem in inventory close and the costing sheet with indirect cost. On ended production order not long ago. So I want to really face that you should, if you're doing production in AX, you should install the KB article 27.71.517 for 2012 and feature pack 1. And then I want to also put you to the 2 white papers that we have. They're explaining the inventory value report. I know the white paper is written for 2009, but originally we made the report for 2012. We had some partners look at it. It was such a big success that they wanted 2009, and then we backported it, and we shipped it for 2009 before we actually shipped 2012. So that's why the white papers are written for 2009, but the report works exactly the same way. So if you want to know, read how to configure the report and how the options are, this white paper is still valid for 2012. So what have we seen? We have seen the costing sheet. We have seen the estimation costing as the first topic. Then we went into how we actual cost by the moving average. Then we went into briefly into the inventory close and optimizations. Then we did the reporting and reconciliation. We saw the new report in R2 that we can actually find all the conflicts in a WIP case. And finally, I showed you the inventory value cube, where we are taking measurements out of the invent trans and make them possible for users to create different charts of the inventory. You can make drill downs from the overall company to item group to products. We have all the dimensions, product dimensions. We have sites in there that you can actually use to drill down. And you can also make the KPIs of weeks of inventory, months of inventory, inventory turn, ABC classification of items, and so on. There's some more information and information source. You can also find information about some of these topics that I've talked about here on information source. And then again, please fill out the evaluation forms that you received. That improves our sessions. So thank you for listening, and I hope I could share some shadow about what we're doing in costing. So thank you. Then we can take questions.
You had the PowerPoint there on conversions.
Yeah.
The one that I was missing there was FIFO.
FIFO is there. Yeah, that's not a costing method. That's a picking method. We don't cost FIFO. It's reservations, yeah.
You want to take mine now?
Yeah, definitely, yes.
Okay, you said about doing the miscellaneous charge against an invoice PO, you can't do it afterwards?
You can do it in moving average, but it will just be fully expensed. So you're not capitalizing the expense then.
Well, the problem with that is that you get invoiced by the manufacturer. It may be 2 or 3 weeks before you get invoiced by the carrier who actually delivered the product.
Yes.
That's where you need to distribute that freight on the items.
Yes.
Saying you can't do that anymore.
You can still do the posting, but it's not capitalized into inventory when you're doing moving average. Only moving average, simply because we don't have the relation. So, for instance, if you purchase 1,000 items, and you only have one left in inventory, and then you get the transportation cost of that, because we cannot make the proportional calculation of how much to expense, if I put the full transportation cost in of the 1,000 items back to that one item in inventory, the moving average will skyrocket. So we chose to expense it because I cannot figure out system-wise right now how much should go in inventory of that transportation cost. So in the case of not exploding the cost in cases where you have already sold most of them, I would rather expense it and say we don't capitalize it at all. If you want to adjust your moving average after that, you can always do that. So that's why. If you know the transportation cost will come, you should actually use it as indirect cost on top of the purchase price instead. Yes. We know your case, and it's not because we won't solve it. We don't. Right now, we have no relation in the system to make it work, and I would hate to explode the cost. I would rather expense, because I'm always allowed to expense. I'm not allowed to capitalize too much. So that's for safety reasons. Yes?
Alex, you mentioned that when you're going to negative inventory, you look for the moving average cost, which is the last posted sales order. Right? What if after that sales order I have got a new purchase, and then there was a stock issue but not a sales order?
Oh, okay, yeah. We always look for the current moving average first. If there is a current moving average, we take that one.
What if the last issue was not a sales order, but that made inventory as 0?
If the last purchase order made inventory as 0,
Last issue was not a sales order. Last issue might have been a stock adjustment. A write-off in the inventory is in on the return.
so again, if you have a moving average that is saved, because even though you go 0 in inventory, we can have in fact that there is a moving average known to the system. That was the last moving average cost. Then we take that one. It's only in the case that if there is no saved moving average, but you're negative, then we take the sales order.
I think the question is just the sales order, or it's also the last issue transaction?
No, it's not adjustment. We don't look for adjustments like that. No.
Okay. Just sales orders.
Just sales orders, yes. Other questions? If you have sites in a site is always a financial dimension, meaning it becomes always a cost object of the product plus site. Moving average can also go to warehouse if you want the moving average per warehouse, if you define warehouse as the cost object level by making it financial inventory. So I know cost object is the level that we do costing on, and the cost object level is defined by your inventory dimensions that is marked as financial. You can have a moving average that is for the product. If you only have one site in the legal entity, that moving average is for the entire product and for the entire company. Yes?
Is there a chance to work back the inventory cube to the present version? Not the 4 or 5, just to not release 2, because it's it's analysis service. So I wonder if you are using some new fields on the release 2, so we can make it for back.
I believe there is a restriction that we cannot backport it, and the reason, as I recall, it is that views cannot be understood because the inventory value report that gathers all the information for us that is used for the reporting is also the views that we're using for the cube. And I believe that the cube cannot read the views in 2009. Something was changed. In 2012 they can, and that's why, because some in the stack changed, that suddenly views could be used for making a cube.
So the cube is going to be backported to 2012?
To 2012, we haven't thought of that yet. If the requirement is there, I thought 2009. Sorry, in my head. Sorry, yeah. Sorry, I was wrong in my head. I thought you said 2009. Sorry. If you want it back to 2012, that really if you come and tell us multiple customers, partners, and so on comes there, we require this, then it should be doable. That should be nothing in the BI stack from 2012 RTM to R2 that should make it impossible. No, there's nothing there, no.
The description in this conflict report, is it based on the posting type which is linked to the chart of account, or the main table of the chart of account? Because you say the posting is not linked to a different account, for example. Is it based on this posting type?
It's based on the posting type, yes. So, but the message is hard-coded in the system, and then we read, oh, this transaction has this posting type, and then we evaluate that posting type to accounts that has been posted on, and then we read, before you execute the report, you need to define which account in general ledger is my WIP, and as soon as we know that, we can match each posting type against what is WIP and not WIP. Yes? You still have to run, you always have to run inventory close in AX. There's two reasons. It actually prevents you from backdating transactions into a calculated period. If you're using moving average for raw materials that actually goes up to a production level, you still need to do inventory close because the production orders can have cost that needs to be recalculated. So you cannot say that you should never run inventory close. It's much faster because it doesn't change the values. You shouldn't expect any changes. Just like with standard cost, really. You shouldn't expect any changes then. Correct. Yes?
Returns and purchasing work the same way, like sales orders with moving average?
If you make a sales order, you can make a return that is at the exact cost. If you make a return lot, we issue back at the exact cost, meaning that it didn't have any effect on moving average. So we are correcting back to like if the sales has never occurred. If you make a blanket sales order return, it goes in as a normal receipt and adjusts moving average with the adjustment that it has. As they happen with a marking, the cost is also specific to the original purchase order. And that means you're correcting like it has never occurred.